Chapter 4 of The Intelligent Investor discusses how to manage and build a portfolio for a defensive investor. This chapter helps investors understand what kind of investor they are and how they should think about managing their own portfolios. This video is going to be our discussion on Chapter 4 and highlighting all of the key things that investors need to know from this chapter so that you can become a better investor. If by chance you haven't seen the other videos discussing previous chapters on my channel, then I would recommend watching those videos as well. I will leave a link in the description, as well as pin a comment at the top of this video with links to where you can find those videos easily. With that said, let's hop right into Chapter 4 of The Intelligent Investor, starting on page 88. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. The first paragraph of Chapter 4 states that the characteristics of an investment portfolio are determined by the characteristics of the individual that owns it. This is an important point because it's stating that your portfolio should be a reflection of you and no one else. Therefore, it's important to think about what your investment goals are. What are you looking to gain in your portfolio of investments? How passive of an investor do you want to be? Do you want dividend income, or do you just care about growth? Answering these questions will help you figure out what kind of investor you are and what your investment goals are. You can then start to build a portfolio that meets your own objectives and goals. The following passage on 88 states, "It has been an old and sound principle that those who cannot afford to take risks should be content with relatively low returns on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return sought should be dependent rather on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor, who exercises maximum intelligence and skill." This is a very interesting passage because it's where Ben states that higher risk does not equal higher returns. He believes that high returns instead come from the level of intelligent effort you apply to your investments, and that passive investors who do not want to think about or manage their portfolios should expect lower returns. This is important because typically we associate taking more risk with higher rewards. I have even heard of investors with small sums of money saying they need to invest in highly risky stocks because that's where they will get the highest returns. However, this is simply not true, and later in the book we will be discussing this topic more in depth, but for now, let's move on to page 90. "We can urge that in general, the investor should not have more than one half in equities, unless he has strong confidence in the soundness of his stock position and is sure that he could view a market decline of the 1969 to 70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus, we would counsel against a greater than 50% apportionment to common stocks at this time. But for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level, and will be satisfied also to limit his participation in any farther rise to, say, 25% of his total funds." On this page, Ben is urging investors that they should not have more than 50% of their portfolio in stocks, unless you are confident that you will not be scared out of stock market volatility. He also says that due to the stock market's high price in 1972, he believes strongly that investors should have less than 50% of their portfolios invested in the stock market. In Chapter 3, we discussed how Graham believed the stock market was unjustifiably expensive due to stocks having lower yields than bonds at that time. This means investors could get higher yields and higher returns by buying government bonds than by buying stocks. Or in other words, investors could get a higher risk-free return by buying bonds instead of stocks in 1972, which suggested that stocks were overpriced. Due to stocks being overpriced and offering lower returns than bonds, Graham suggested investors should own more bonds for their higher risk-free returns. He then confirms this conclusion on the next page where he writes, "The much higher income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component." It's clear that Graham was in favor of investors owning more bonds than stocks in 1972 due to the higher yields that they were offering. In 1972, bonds were offering roughly 6.5%, and the stock market at the time was trading for a price-to-earnings ratio of 18. A price-to-earnings ratio of 18 is equal to an earnings yield of 5.5%, which means stock yields were 1% below bond yields, and that investors could be getting higher risk-free returns by buying bonds instead. As we discussed in Chapter 3, Graham was always looking at where investors could get the best returns on their cash. And when bonds are yielding more than stocks, it suggests that the stock market is expensive. Graham proved to be right as well. And by 1974, the stock market fell by 48% from its peak in 1973. It also took until 1980 for the market to reach new highs, which meant it had almost a decade of no returns. The current price-to-earnings ratio of the market today is 23.5, which is an earnings yield of 4.25%. Bond yields have recently spiked rapidly over the past year and are currently offering 4.9%. This means investors could be getting higher risk-free returns by buying bonds instead of stocks in 2023, and it could be argued that stocks are expensive today. This is also why investors are so worried about what is going on with bond yields and interest rates and what they are going to do. Because if bond rates continue to rise, they will be increasingly looking like the better investment over stocks. So it's always important to look at the available options and different returns on investment vehicles, and consider which ones make more sense as things continue to change. The next important passage is on page 97. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank, or from a bank certificate of deposit, as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions, they are a suitable substitute for short-term bond investment by the individual. This passage states that the interest rate on savings accounts were on par with bonds in 1972. Because of this, Ben suggests that savings rates were high enough to replace bonds in the investor's portfolio. The advantage of savings accounts over bonds is that they give you liquidity, whereas bonds tie up your capital for a number of years. Therefore, an investor at this time was able to produce equal returns to bonds while also having liquidity, which made bank accounts a more attractive investment than bonds at the time. Also, this shows that the intelligent investor should be willing to adapt to the environment they're in and change their portfolios based on where the best risk-reward opportunities are. Ben even says that high interest rates on savings accounts may not last in the future, but for the time being, they were the better option, which shows that investors should stay nimble and always adapt to the circumstances that they are in. The next passage is on page 98, where Ben discusses preferred stocks. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted, or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay the common stock dividend. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus, the preferred shareholder lacks both the legal claim of the bondholder and the profit possibilities of a common shareholder. On this page, Ben is saying that good preferred shares can and do exist, but in general, preferred shares are a subpar investment. The reasons are because the preferred shares do not offer you any ownership of the business and no legal claim to any compensation. The management of the business also has no incentive or obligation to pay the preferred share dividends if they end up cutting the common share dividends. Therefore, when you own preferred shares, you're relying on the business's ability to pay its dividend on the common stock for you to continue receiving your dividends as well. Therefore, there are major disadvantages to owning preferred shares, as they require a deep understanding of the business that owns them, its financial health, and its profitability. On page 99, Ben continues this discussion and summarizes it where he writes, "The owner of preferred stock is entitled to a fixed dividend and no more, which must be paid before any common dividend." This page concludes his thinking on preferred shares and says their owners are only entitled to a fixed dividend, which must be paid before the common share dividend. That's all you get when you own preferred shares. So be aware of this and really understand the business that is paying out the dividends if you're going to look into owning preferred shares. But now let's move on to the next page, which is page 101, which also now is getting us into the commentary by Jason where he writes, "How aggressive should your portfolio be? That," says Graham, "depends less on what kind of investments you own than on what kind of investor you are. There are two ways to be an intelligent investor: by continually researching, selecting, and monitoring a dynamic mix of stocks, bonds, and mutual funds, or by creating a permanent portfolio that runs on autopilot and requires no further effort but generates very little excitement." Graham calls the first approach active or enterprising. It takes lots of time and loads of energy. The passive or defensive strategy takes little time or effort but requires an almost ascetic detachment from the alluring hullabaloo of the market. As the investment thinker Charles Ellis has explained, the enterprising approach is physically and intellectually taxing, while the defensive approach is emotionally demanding. Jason writes once again that there are two types of intelligent investors: the active and the passive. The active is when you want to research your own stocks and try to find individual investments that can offer you higher returns. The passive investor is someone who just wants to grow their money as passively as possible, while not researching individual stocks or investments. For example, index investors who dollar cost average into the market are perfect examples of passive investors. They simply buy index funds whenever they can, and they don't worry about researching individual stocks or finding discounts in the market or anything like that. This is also perfectly fine, and also a form of intelligent investing. The type of portfolio you have and the type of investments you make depend on you as the individual, and how much effort you want to put into your portfolio. It also depends on your risk profile and your investment goals. So once again, take the time to consider what matters most to you in your portfolio and what kind of investor you want to be. The next important paragraph is on page 102. The most striking thing about Graham's discussion of how to allocate your assets between stocks and bonds is that he never mentions the word age. That sets his advice firmly against the winds of conventional wisdom, which holds that how much investing risk you ought to take depends mainly on how old you are. Here Jason says that one of Ben's most striking ideas was how he believes investors should not consider their age when they are investing and considering risk. There's many different opinions here, and many different made-up strategies, but Graham doesn't seem to make any case that younger investors should take on more risk. Jason continues his thoughts on page 103, where he writes, "Why should your age determine how much risk you can take? An 89-year-old with $3 million, an ample pension, and a gaggle of grandchildren would be foolish to move most of her money into bonds. She already has plenty of income, and her grandchildren, who will eventually inherit her stocks, have decades of investing ahead of them. On the other hand, a 25-year-old who is saving for his wedding and a house down payment would be out of his mind to put all of his money into stocks. If the stock market takes an Acapulco high dive, he will have no bond income to cover his downside or his backside." Jason writes that an older person with $3 million would be a fool to put all of their money into bonds. The reason is because a $3 million portfolio of stocks is most likely already providing a significant amount of dividend income. For example, even if the portfolio only has a 3% dividend yield, then it would be generating $90,000 in dividend income annually. This is probably more than enough for an 89-year-old to live off of and survive. Therefore, there seems to be little reason for this older person to invest all of their money into bonds, which do produce a risk-free return, but typically do not produce as much of a return as stocks over the long term. Additionally, a 25-year-old who is saving for a wedding or a down payment would be foolish to put all of their savings into the stock market. The reason is because in the short term, the stock market can be very volatile. Therefore, if you have money that you're saving to get married with in the next year, or buy a house within the next few years, then it's not a good idea to place this money in the stock market. The market could, at any time, see a significant decline over the next few years. Therefore, placing money you need and cannot lose within the next few years in the stock market is just foolish. If the market ends up going down by the time you need to pull out your money, then you're going to lose money and potentially have less for your wedding or for your down payment. As we learned in Chapter 3, the stock market has also had periods where it declines for multiple years. Stocks are also not guaranteed to go up in the short term. Therefore, placing money you need in the short term in the stock market is gambling that stocks will go up by the time you need to pull your money out. This opens the door for you to become a victim of volatility. Instead, if you do have money you cannot lose within the next few years, 1-year government bonds would seem to be the better option. You can invest the money in these bonds and earn a return on the money without risking any loss of that money. So the amount of risk you should take depends on you as the individual and your needs with your capital at the point of life you're in. Just because you're 25 does not mean that you should go all in on stocks. And just because you're 89 does not mean that you should be entirely invested in bonds. A 25-year-old's best option could be bonds, and an 89-year-old's best option could be stocks. It all just depends on you, your circumstances, your goals, and what your needs are. But now let's move on to the last page of this chapter, which is page 111. No intelligent investor, no matter how starved for a yield, would ever buy a stock for its dividend income alone. The company and its business must be solid, and its stock price must be reasonable. This passage is saying that no intelligent investor would ever buy a stock just for its dividend yield that it offers. When you're investing, you may notice stocks that have dividend yields that seem insanely high, like 20% or more. However, these stocks usually have high dividends because they're unsustainable or extremely risky investments. The stock market is usually quite efficient, so if investors are pricing a stock where it has a high dividend yield, then you need to be asking yourself why that is. Why are investors avoiding this stock and allowing it to produce such high yields? If you're going to buy any stock, you always need to understand the business behind it. Dividends are paid from the business's profits, so understanding how much profit the business generates, how sustainable those profits are, and how much of those profits go towards paying the dividend is absolutely crucial. Do not fall into the trap of buying a stock just for its high dividend yield, because it usually turns out to be a mistake. But that is going to wrap up chapter 4 of The Intelligent Investor, and I really hope that you all enjoyed this video. If you did enjoy this video, then please remember to leave a like on it, as it really helps out my channel and gets this video in front of a wider audience. The goal of my Intelligent Investor videos is to help more investors become, well, better investors. So if you would like to help me on my mission, then share this video with some of your friends, share it on social media, and again, just simply give it a like. Also, if you do want to stick around and see more of my Intelligent Investor videos, then make sure to subscribe to my channel and turn on the notifications, because I'm trying to put out one of these videos about every 2 weeks right now. Also, I am very excited to finally announce that my own investment book is finally almost finished. I've been working on this for about 2 years now. I've been plugging away at it, and I am so close to being done. By the end of 2023, I'm really aiming to have the book done and hopefully in people's hands. So if you would like to stay up to date with my own book and when it will be released, then again, make sure you subscribe to the channel, because I will be announcing it when my book is finally out. But with all that being said, thank you all again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.